Okay, I just started the recording, and then I wanted to make sure that you saw the message on Blackboard, because if you see that I'm sharing the screen here, I wanted to convert the 3 deliverables to group deliverables, in your project teams. And the reason why I wanted to do that was basically, just offload a little bit of the work and make it a little easier for you to get things done. So what I've done then is that you'll find that completing the participation activities 6A and 6B, it will prepare you to do this Cupcake assignment, which was originally a pair assignment or a single assignment, and now it's a team assignment. What I have to tell you though is that because some people have already uploaded to those posts, I can't change the assignment to groups. So what I'm going to ask you to do is pick a person in your team that represents the group and identify the 3 people in your group so I know how to disseminate the marks, and then upload the results in those 3 areas as an individual. And then the other 2 don't have to do that. All right. So that's what I'm asking for. So does that make, do people understand that? And I think I'll put a note out to that effect again, just in case some of the people who don't attend this webinar don't understand what happened. So can I maybe get a thumbs up on what you understand I said? Okay, thanks, Seja. All right, where do I begin? So what I want you to know is that when you see, when you want to find out what the deliverables are for a team activity, the best place to go is to the overall slide deck that Professor Powers has created. And in the topic 6 slide deck, these 2 slides are there showing what you need to do. So there's 3 things which I call deliverables, and then I've just typed them out here so that you can see that. So on team activity 6A, you'll have to calculate the cost of goods sold for the gingerbread house, and make all the assumptions that you need to, in terms of costs and what you're going to do. Calculate the gross profit, and again, it gets back to the message I sent you that you really need to go through all the videos that are on topic 6 to understand, how you can get this all done. And she does a really good job of explaining what she did, in terms of her gingerbread house that she prepared, and it'll give you a good sense of how to get this done. And then answer a question, how can profitability be improved? Okay, so that's what you need to do on that one. And if you do activity 6A as a group, and then you do activity 6B as a group, then it'll really set you up to be able to complete the Cupcakes assignment. And you can see what's in bold here is that you need to calculate cost of goods sold and profit calculations right here. So you'll have done that in 6A, so that'll be a good prep. And you have to understand cost of goods sold percentage, and you're gonna and that's why again that the video is so important to understand, where she got this from, and then create a balanced scorecard, which you'll have done in 6B. And again, focus on 3 of the key performance indicators. And I'm going to elaborate on that because, that in some cases, in this topic, you're gonna need to calculate 15 different financial ratios. And, in real life, it depends on what industry you're in, what kind of business you have, what kind of organization that you have to run that business, and that determines, what are the most important, which we call key performance indicators. So it's not as if you're going to have to come up with 15 financial ratios for your business. You're going to go with what you really, ties into your critical success factors of sustaining and growing that business. And that's why, in the Cupcake assignment, we're asking you just to do, 3 KPIs, performance indicators, and make sure that they're the most important ones. So it makes you start thinking about, you know, more around the strategic aspects of being more successful. So that's where I'm coming from right now. Somebody's posting right now on that, or sharing, and I don't know why that's coming up. But let me take this down here. Okay. All right. Okay. So again, so 6A will be able to help you do part of the Cupcakes assignment. 6B will do that. All three now are group assignments. The group assignment is due on the Friday of October 27th. I've shown that these 6A and 6B are due today. But you know, I'll accept those late, and no problem in terms of late submissions. All right, so that's where that is. Okay, any questions at all? You can unmute right now and just unmute and ask the question if it's not clear. Okay, so what I want to do is I want to you know, maybe take you through just the let me see the I can't. All right. What I wanted you to do is make sure that you know where the week commentary is, and you know, in the navigation panel just below all 13 of the topics, you'll see weekly commentary. You click onto that, and there's you know, all the weekly commentaries I've been doing, and you'll go down the list and you'll get down to weekly commentary 6. And I placed a lot of documents in there, and in that notice that I sent you maybe 2 days ago or yesterday, you know, there's things that are important there. There's the assignment rubric is in there, and then there's an Excel assignment template, and that's to help you, you know, not have to create everything from scratch. Now it doesn't have everything in there to answer or address the full Cupcake assignment, but most of it's there. And then use that, you know, if there's anything missing, that's where you put it in, right? And that's what I created for you, so that it makes it a lot easier, and you know, it's less tedious to be able to get this assignment done. And also, what I did was when I start going through my commentary presentation, you're going to see that you know, I'm trying to explain, you know, what was in the first video that Professor Powers did in terms of going through that slide deck. So I created an Excel spreadsheet to kind of, that you can print out and then track, so you'll understand, you know, where she's going, because sometimes she talks about 3 different ways to define some particular, like say gross profit or that kind of thing. So you'll be able to see it to the right, so that you know, you can follow her much better. So that's what I've done there. Okay. All right. So what I'm going to do is I'm going to try to get through this presentation as fast as I can, because there's about 70 some slides. So stop me anytime. And again, you know, use the chat, you know, if you've got questions, and also, you know, when I'm asking you for feedback, if you don't quite understand, show me a sad face. Otherwise, I'm going to ask you to, you know, give me a thumbs up that I can go on to the next items. Okay. So any questions at all right now? Okay. So remember, you're working in your project group, your group project teams. All 3 of these assignments are group assignments, and the first 2 pieces in the participation, you're working with creating come on, help me out here, a gingerbread house, you know, for 6A and 6B, and then when you look at this next assignment, you're working on cupcakes, and there's about 3 links in that assignment where you can get more information. But if you go to my commentary, like weekly commentary 6, you'll see that I've actually put those files right under that as well, so you can access them easier. Okay. All right. So what I'm going to do right now is I'm giving you a gimme, for test number 2. There's a question in here on this slide, and we're going to be talking about scientific management a lot, and that's where profitability and those kind of things come from, because now we're starting to compute the success of the business under the scientific era, and just remember that the father of scientific management is Frederick Taylor. All right, so that's a gimme. So I'll start right there. So again, I'm mimicking the slides that are going through, but what I'm trying to do is I'm trying to focus on the ones where maybe you need a little more clarity, or I can give you a little more information to be able to give you a better understanding of where we're going. Right. So what's financial management? So we're still under the 4 functions of managing: planning, organizing, directing, and controlling the business functions. But again, the planning, organizing, directing, and controlling of the business functions are concerned with, not only profitability, but how you run the business, your customers, and how you're building the capacity of your organization. So introducing you to the balanced scorecard concept, this is it right here. All right. And this was generated by Kaplan and Norton, and they're from Harvard, and it started in the 90s, and then they just refined it. But there's 4 main areas in the balanced scorecard, and there's the financial area, no doubt, and that's what this whole topic is all about, and that's everything that you're going to be calculating is just related to financials. But when we get into the planning side of the business, I'm going to show you, how these other 3 kind of fit in. So there's the financial aspect, there's the customer aspect, and then there's learning and growth. And what learning and growth is that, how do you enhance the capacity and the capability of the organization? And there's a term that you can use. It's called organizational capital, and it has nothing to do with funds. It's, when you talk about political capital, well, that's when, when you first start as a politician, you could pull a lot of favors. So you've got a lot of political capital when you get started. Organizational capital is basically, hey, you've got the capacity and you've got the capability to get things done through your employees, through your systems, through your processes, and all those things. So that's what that's all about. And then the internal business processes, people seem to neglect that in some ways. And we know that if you improve the efficiency and the effectiveness of your production and operation systems, you'll improve your profitability, right? So that's key. So why did this come about? Well, back in the 70s, the main reward system, for organizations was top line revenue. So no matter how you brought that revenue in, you got rewarded for it. But what happened was, people were overselling the capabilities of the products, so the customers weren't satisfied. They were selling things that maybe even the organization couldn't provide. And then they were making deals just to make sales and not really, help the organization, or they were selling something that hadn't been fully designed or produced properly yet. So Norton and Kaplan said, how do we get around that? Well, they created a balanced scorecard. And so that if you manage these 4 areas, then it's gonna balance itself off, and that's where it came from. Okay, so again, we're focusing now, topic 6, really on the financial side. So this is why we're looking at profit planning process, and that's where you establish a profit goal and you determine the volume of sales revenue needed to make that profit. You estimate your expenses for reaching the volume of sales, and you estimate the profit. And so I'm going to introduce you to my type of planning. It's sort of, where are you now? Where do you want to be, and how are you going to get there? So where are you now is you're starting off and you've got some existing inventory and everything else. Where you want to be, that's where you set your sales goal. And then how you're going to get there, that's where you start talking about, well, you set a target for your sales goal. So now you need to come up with metrics or measures, which we call key performance indicators, to be able to measure, to know that you're reaching that goal, and how far are you getting close to that goal, to give you an idea of how do you recalibrate to get to that goal if you're not quite making it, and those kind of things. So that's what that's all about. And so there's many ways to calculate profit, and here's all the lists that Professor Powers came up with: sales growth, cost of goods sold, overhead percent, gross profit. I'm not going to read them all to you, but we're going to cover a lot of these as we go through this presentation. Okay, but now I want to tell you about the real world, and it's all about cash flow, right? And the whole idea is, so here's a couple of things. So if you don't have cash, you can't run your company. And if the financial institution that lends you the money knows that you're lacking in cash, they're likely to pull their loans, and then you're really in a big pickle. So here's one thing: if your revenue is not growing faster than your cost of goods services, cost of goods amounts, if your revenue is not growing faster than that, well, then you have a negative cash flow, and that's how it's all keyed in to be able to know how well you're doing. So understanding your cash will give you powerful insights into where your money is going during particular periods, because sometimes, some businesses are more seasonal than others, and they have to make up for the fact that they got more money going out than coming in at times. And again, just to know that cash is king, all right? And what I can tell you, if you're going to start your own business or whatever, and you're going to choose an accountant, the best thing you can do is to choose an accountant that has controller type skills. Not just they're going to do your financials for you so you can file your income tax at the end of the year, or just make sure that your payroll gets paid, but understand how knowing how your cash gets worked in and what to do with it, and give you good advice. So look for a controller type of accountant, not just a straight accountant. So if you want to get serious about business success, like hold on tight and keep an eye on your cash flow. All right, that's key. All right, so here's a slide that I hope that you'll read in your leisure time. What does a controller do? But essentially, it all comes down to this: what gets measured gets done, and your controller will help you pick out the right kind of key performance indicators, the right kind of targets for your business, and keep you abreast of if you're making your targets or not, and look at, maybe there's certain bank loans that you need when they're necessary because you're a little low, and that controller would be able to help you a little better on how to select the right kind of financing for the certain conditions that you're in as you're going through, going through the highs and the lows of your cycle, right, of your business cycle. So again, here's this thing again where you establish a profit goal, and that's your goal piece, and then work through that piece. So we repeated that. But here's the thing, you need to know what your sales growth is, and your sales growth has to be quicker or better and bring in more cash than your cost of goods sold expenses. So how's it, what's the challenge then? If you're not growing your business, it's declining. So because we know that costs are increasing over time. There's inflation, there's wage hikes, there's, higher costs of raw material acquisitions. All those things are lumping on to your costs as you're growing your business. So you really need to keep ahead of that by accelerating your sales growth. And so what are the options? Well, you increase your revenues, or you're really looking into decreasing your costs, or you improve your existing offerings because then it'll appeal to more customers, and you can actually sell more, or maybe create new offerings, and you start looking at, maybe have 2 or 3 products, and what are some other products that would fit in that overall product line to be able to increase your growth revenues over time. So this is not on a test, it's not in the materials, but I wanted you to be aware of this because Professor Powers talked about this, but didn't really kind of say where it was coming from. But there's a thing called the ANSOF product market mix. And what you need to look at is if you're in your business, you're producing existing products in your okay, am I not sharing my screen?
No.
Okay. How long have I been going on without sharing my screen here?
About 10 minutes, I think.
Oh my goodness. Okay. So let me just go back to, okay, I mainly just talked about that. So, okay, we're good because I don't have the, too many illustrations that you missed on. Okay, so thanks for doing that. And please, sometimes I get ahead of myself and I forget to share the screen again. I don't know why it came off, but I was sharing it when I started. But in any case, so here it is. So right now you're in your business and you've got existing products and you've got existing markets. And what you're trying to do is you're trying to grow inside of that. That's market penetration. But if you're looking to increase your revenue and keeping it, at a higher level, what you can do is that you can go off to the right and produce new products, or go off, down the left-hand side and go to new markets, and normally that's what happens when you're producing a product in your own country and you're saturating the market, and then so your sales start declining. Well, that's the part where you say, geez, maybe it's time to export this to another country, to increase my sales. Right, and so that there's different strategies. So when you're looking at new products in existing markets, you're doing product development. When you're looking at new products in new markets, you're diversifying. You're increasing your product line or whatever, and you're diversifying your portfolio. And you might even take on a second business because it's complementary. What you got to remember though is that when you're going this way, you're increasing your risk. When you're going this way, you're increasing your risk. So when you get down into this quadrant, you really have to know what you're doing. That's the only thing I'm going to say. I'm going to leave that at that point. Okay, but there's different ways in increasing profitability, and you have those questions in three of those assignments that are due. So how do you increase profitability? Well, you can raise prices, you can lower your variable costs, you can smooth out your seasonality. So if I'm a snow machine producer, well, what happens in the summertime? There's no snow. So maybe I might get into watercraft, and that way, I can smooth out my seasonality and make sure that I've got cash flow 12 months of the year. And when you talk about lower your variable costs are associated with cost of goods sold, right? Those are direct costs to production in most cases. Because when you produce more, you need to buy more raw materials. You need to consume more power. You need more packaging. So that's the one part. But we're going to talk about overhead, and overhead really is your operating expenses that is other things like your fixed cost a lot. With having a marketing department and an accounting department. And you're better off. It's easier to increase your profitability by looking at lowering your costs in your overhead than it is through your cost of goods sold. I mean, you could do both. Don't get me wrong, but it's easier to do some things because sometimes on your overhead you can defer costs. You can say, well, you know what, we're not going to hire that additional HR person. Because we don't really need them until next year, those kind of things, right? Okay, so here it is. There's your topic 6A. These are the deliverables. So you should look for these kind of slides in all the topic slide decks to be able to know what you have to do for a team activity. So you're going to calculate your cost of goods, you're going to calculate the gross profit, and how can profitability be improved. And what it is, you're going to do this for a gingerbread house. And you have to make some assumptions. But what I did was I put, if you go to the weekly commentary and you go to weekly commentary 6, you're going to see I put an article in there on how you can set up your local home bakery kind of thing to make costs. And there's a lot of ideas there that might give you a better idea of how you can pull this off. And again, you make some assumptions and reasonable assumptions. And then another thing is that if you go to the Cupcake assignment with the materials that you've been given with, to do that assignment, you'll see a recipe and you'll see costs, and go over those, and it'll give you an idea of the categories of costs to be able to put into this participation 6A team activity as well. So that's going to help you. All right. So now we're going to talk about this. And what you need to do is develop or calculate the cost of goods sold. And those are direct costs of producing the goods sold by a company. And what that means is that for labor, it's the labor that are deployed directly to make that gingerbread house. So you may have a manager. Well, that manager is a fixed cost. That doesn't go into cost of goods sold, just so you know. So I've listed these things. And again, you know, like I said, cost of goods sold differs from operating expenses. Professor Power calls it overhead a lot in this, that they mean the same thing, but OPEX includes expenditures that are not directly tied to the production of goods and services, right? Cost of goods excludes indirect costs such as, you know, sales and marketing, and, you know, all under overhead. Okay, but then you're going to have to calculate the percentage cost of goods, and the way to do that is that, you know, you put the cost of goods that you calculated over the sales for that period times 100, right, to get percentage piece. But this is key. And again, you know, if you're looking at cost of goods sold, it's beginning inventory plus purchases minus ending inventory. So, you know, you're starting in the gingerbread business, basically you have no inventory. So your beginning inventory is 0. And then you're going to produce a certain amount of gingerbread houses, all right? And maybe you have material for 20 gingerbread houses, but you've only made 10. So, you know, your ending inventory is the work in progress inventory, like the crackers and the icing and the, you know, the gummy bears that you used that's left because you didn't do the whole amount into full gingerbread. So that's going to be your ending inventory. So let me go back to, I hope I remember. So I said, okay, you're going to build 20 gingerbread houses. You have 0 beginning inventory, but you buy inventory to make 20 gingerbread houses. You only sell 10, so it means that your end inventory is the raw materials and stuff that you had left, you know, after you sold those 10 gingerbread houses. Okay, so that's where that is. Okay, this example here is just it's a bad example for staying in business. All right, so what I'm saying here is that your sales should always be increasing well over your expenses, and you know that your expenses are always going to be growing, so you really need to put a lot of effort into your sales. So you can see in this particular graph, well, the cost of goods sold was below the sales amount, you know, for expenses, so that the what you paid for this is less than what you're going to get back. But look at, and you know, and near the end here, your general and administration expenses, your overhead, you know, is less than that, so you're doing okay. But your other expenses and maybe you spent some money in other areas are way over sales. So this is a losing business, just so you know that. So the whole idea, your sales line should be up here, okay, much higher than what these all add up to. Okay. Not going to talk about that. Okay, so here's a link to this, you know, how to price a home baked goods and make profit. And I actually put that document also in your commentary week 6. But if you want to go directly to it, that's the link to get to it. It'll give you a better idea of how to set up your cost of goods sold, you know, for your gingerbread house. Okay, all right. Operating expenses is overhead. And that tells you what it is, and then why they're super important. Okay, you got to reduce operating expenses. Maybe the best one in terms of, you know, what I just told you earlier. If you want to reduce your expenses, you know, start looking at your overhead, because when you try to decrease your cost of goods sold, maybe you're using cheaper labor. If you use cheaper labor, what happens? You might have poorer quality. If you use cheaper goods, you may have, you know, poor quality of the output, like the taste of the gingerbread house, those kind of things. So that's why, you know, start at the overhead or the OPEX first, and then take a look at what you can do here on how you can reduce the costs of goods sold. And then here's some examples of overhead or operating expenses: accounting fees, license fees, utilities, travel. Okay. Okay. So you're going to be asked to do an income statement in the group assignment for the cupcakes, and that's why I'm saying you really should go through all the videos that Professor Powers created, so that you know, she'll take you through all of this. But this is how this sale works. This slide works. So you start with sales. So that's your total revenues. All right. And then if you subtract your cost of sales or cost of goods sold from your sales, you get your gross profit. So now you're at your gross profit. If you subtract your operating expenses, that's your overhead, now you get to operating profit. And that's otherwise known as earnings before interest and taxes, EBIT, right? Same thing. Operating profit is earnings before interest and taxes. Now, this will not apply to you, in your project, but for a business, sometimes you get non-operating income. Maybe you sold, a building or whatever, or you have non-operating expenses. You got into a lawsuit and you had to pay a lawyer. So you add the non-operating income to operating profit and you subtract the non-operating expenses from operating profit. And what do you get? You get net profit before taxes. Okay, so you have net profit before taxes, and then you pay your income taxes. So net profit before taxes minus income taxes gives you net profit after taxes. So when you go through all that, you'll understand, where you put what. All right. And again, I can't remember if I told you, but when you do that Cupcake assignment, there is a template there that you can use, for putting in all your inputs, and that'll make it easier for you. Okay, so again, how do you calculate profit margins? Well, there's different types of profit margins, right? There's gross profit margins. So you take your gross profit, you divide it by your net sales, and times 100, and that'll give you gross profit margin. So margin is, the percentage ratio of what your profits are to your revenues. Basically, that's what it's all about. And then your operating profit margin is your revenues, plus your cost of goods sold, minus your selling and administration expenses. That's your OPEX right here. Okay, that's your overhead. Divided by revenues times 100. So that gives you your operating profit margin. And then net profit margin is your net profit divided by your total revenue times 100. And going through this, you'll understand this. Okay? All right. And there's other profitability measures. And why? It's because sometimes, depending on the nature of the business, some different functions will tell you more about your business success than others. And so that's why you really should understand, what's it costing you to sell things, right? So what's your selling cost percentage? Well, that's the selling and your marketing expenses divided by your sales times 100. And then, how about other overheads? You may have other overheads that are maybe in particular that you want to pinpoint because you want to say, like, how important are these overheads? And you'll find out by knowing that, if you take your overhead and you subtract the selling and marketing costs and over sales, and then you'll see that, oh, what's going on here, right? And then the rest of the overhead decreases with sales. So you can see that. Then you can take the earnings before interest and taxes, and then go one more step. And this is what, when I was a sales director at TELUS, this is the one that we really used because it really gave a real good sense of how profitable, TELUS was in our areas of what we were doing. So we have EBITDA, and that's earnings before interest, taxes, depreciation, and amortization. Okay, minus a rough estimate of cash generated by operations. But just so you understand what amortization is, it refers to expensing intangible assets, let's say copyrights. So let's say that you've spent money on copyrights. You don't get anything back for that, right? That's almost like that's a goodwill thing where you spent money on copyrights, and say you spent $100,000. Well, you don't want to deduct the whole $100,000 for the year that you put it in there. So you will amortize it, over maybe 10 years. And the amortization then is you'll deduct, $10,000 each year for 10 years to show that, you're, a good sense of what your profit looks like. Okay, so that's what that's all about. Okay, so financial needs of an organization, well, you need startup money. you need to know, which costs are one-time versus ongoing. So you know that you're always going to need electricity. You're always going to need to buy, a new vehicle at some point in time. But there's some one-times where, well, just registering the business, that's a one-time. You don't have to register it every year. And then what are your fixed costs and variables? So your fixed costs, are okay. You've got to pay the mortgage on your building. That's a fixed cost. Whether you sell anything or not, every month you got to pay your mortgage. That's a fixed cost. Electricity, or your rent, or your management fees. Maybe you have two managers on your payroll. You have to pay those two managers every month, regardless of how much you sold, right? And then you have variable. So variable, it depends on your production of your offering, whether it be a product or a service. And so that from a product point of view, okay, you're building gingerbread houses, so you're buying Graham wafer cookies to build those gingerbread houses. You build more gingerbread houses, you buy more cookies or Graham wafers, right? So that's a variable cost. And then which costs are essential and which costs are optional. And that's almost a strategic decision as well, is that you take a look at what's your vision, and some things may be more important to that vision than others. And guess what? Those more important things are your essential costs that you're going to have to cover. So that's one example of that. Okay, and then I kind of talked about the functions of management apply to each four of those areas of the balanced scorecard. The financial area, the internal processes of business, the customer area, and the growth and learning, which I call the organization capacity and capability, right? And you're going to plan, and you're going to organize, and you're going to control, and you're going to lead in those four areas. So that's what you have to understand. But we're mainly talking about the financial piece for these exercises. So you're going to be concerned with profitability, expenses, cash, and credit, so that the organization has the ability to fund its operations, right? That's what that's all about. Okay, so there's different areas of the financial management. Treasury management, well, those are the people who manage your cash flow. And they look at your accounts receivable. So you sold 10 gingerbread houses for $1, you're going to get $10 in your accounts receivable. Okay, but you spent $6 for those 10 gingerbreads, for expenses. So now you've got to pay that $6 out as accounts payable. And then your capital structure, well, maybe you're going to borrow money to run this start and run this business, or maybe you're just going to go after, somebody who wants to invest in your business in terms of equity. Okay, and then the difference between debt and equity is debt, you pay it off, it's done. But even if your business crashes, you still owe the debt. But on the equity side, if somebody's bought a share into your business, you only pay them when you're profitable, but you pay them for the existing length of time that you're in business. So that's how that goes. And then working capital management, and that's key. And working capital could be a killer in a business. And I think I probably told you this maybe 3 or 4 times already, but inventory is one form of working capital that can break you. And because sometimes it represents 35 to 65% of your costs, and that's some research that was done in North America, all right? So what you'll do then is you'll analyze financial ratios, and we're going to get to those 15 ratios that you have to calculate for this assignment as an addition to the Cupcake exercise. And then you create a strategy to ensure the assets, liabilities are managed effectively. So how are you going to manage your assets? How are you going to manage that cash that comes in your business? How are you going to manage, your buildings and stuff? And then how are you going to manage servicing your debt and those kind of things? And then risk management, and that's a different section right at the end, of this topic 6. And that's key. It used to be that, in my day, only the accountants worried about risk management. And today's world, with terrorism, misinformation, climate change, everybody's responsible for risk management because there's so much risk all around. And I'll get to that at the end of the presentation. Okay, so how to finance your business? You're going to get into debt financing, or you might get into equity financing. So you're going to borrow, And again, the balance sheet, which you need to produce, is going to take you to short-term debt and long-term debt. And I'm going to show you in the next slide, what that looks like, right? So what you're looking at is, bonds. So you can issue, big companies issue their own bonds, which means that, people pay the money, and then at the end of that period, they're paid back their bond plus the interest rate that they said the overall bond was going to yield. And then asset-based financing, where, you may take a mortgage out on a building and some equipment, on a building, all right? So that's the collateral is the building for your mortgage. But what a chattel mortgage is, it's a physical asset other than. So sometimes, you may have to take a chattel out, along with this mortgage, because maybe the building is a little bit in ill repair, and they'll say, well, you know what, you've got a $100,000 RV and you're parked in your driveway that's clear title, and we will hook up to that through a chattel, so that if you don't pay us back your loan, not only will we liquidate your building, but we get a hold of your RV and we can sell that to cover our losses. Okay, so that's how that works. So here's, with the short-term securities, that goes into current liabilities on a balance sheet, right? The long-term securities, that goes into long-term debt. And then if you're equity financing, then you get into shareholders' equity and how that looks like. So that's where that goes on the balance sheet, and in terms of liabilities. And then here's where you put all your assets in terms of cash. The accounts receivable, those are assets, because that's money that's coming to your business. Prepaid expenses is, maybe you pay your insurance all in one lump sum over a 3-year policy. Well, then, you will claim some of that each year as a prepaid expense and show that on your books. And then your inventory, how much inventory, that's, that, and again, that's working capital that's inside of your assets here. Okay. So I spent many years on credit union board of directors, and so a lot of times talking with the lending side of the business. Here's what I found about small and medium-sized business, mainly small businesses. So if you are intending to build a small business, most times small businesses start off with, hey, I got a pile of money, I'm going to invest it, I'm going to start my business. Or, hey, I've got great family members, they're going to lend me money, and then I'm just going to pay them back. And so you get to a point where you want to expand. And so then you finally go to a lending institution, say, I want to expand, I need some money. And they say, what can you do for us? Because you don't have a track record. You don't have any history of, paying back your loans on paper with, larger institutions. So what I'm telling you is, if you're a small business proponent that you want to leave this program, you want to start your small business, at some point in time, start opening up like a corporate lending account, so that you could start creating a track record and understand, how to deal with different types of corporate lenders, so that you're seen as viable when you want to make that leap to the next level of growing your business. So that's key. And I just put that in there just so that you know that in the back of your head. But wow, there's all kinds of sources of equity. There's small company offerings registration. And what that's all about is that normally, if you're a large company, you go to the stock exchange and you create an initial public offering. But that doesn't come cheap, right? You need lawyers, you need accountants to build all the documentation, to register and all that. And as a small operator, it takes a lot of money to do that. So the SCORE, small company offering registration, will help small companies, do a common stock issue, but not with all those expenses, so that you can get it done. And then there's small business investment companies. There's venture capitalist firms looking for a rapid growth. They're sharks. Okay, they will suck the control out of you and chew you up and spit you out. So just be really careful when you start looking at a venture capitalist and what their terms are and how they're going to manage their investment inside of your corporation. Then there's angel investors, and these are high-income individuals, and these are mainly people who look for character. They're character lenders, and they build, and they'll loan money to you on trust. But you you have to pay them back, and you have to find ways of doing that, and you're going to do that. Or the last one is employee stock ownership, where you have some employees in your business, and you bring them on board saying, hey, we want you to be a shareholder. We want you to be part owner. So, put some money on the table and we'll grow this business. And those kind of situations are very much a win-win situation. And there's some great success around that. Okay, so how do you measure profitability for the investor? Because the investor, somebody's going to buy shares from you, so they want to know how well they're doing. So what you do is you start measuring earnings per share, and what you have then is you have your okay. Let me just stop right there. So there's two kinds of investors in the stock market. One is the common stock, and you can vote when you buy those common stock. And then there's the preferred stock. And that's, you don't necessarily most times you don't get to vote, but you're paid a premium, but you're guaranteed, as a preferred investor, you're guaranteed that you're going to get paid first. So if there's only so much profit, you get that portion of the profit, and the common stock, once you're paid, if there's none left, the common stockholders don't get any more. So that's why when you look at earnings per share, you have net income minus the preferred dividends, because that goes to the preferred shareholders right off the top, and then over the weighted average common shares outstanding. So those are the common shares that are out there, and then what you'll do is you'll get an earnings per share. And the thing is that if this is not growing, you will not be able to attract very many more investors, because if it's not growing, it means your company's not growing, and it's not a solid investment for them. They don't have the confidence to be able to buy your shares and allow you to grow more. And then we get into price earnings ratio, and this is where stockholders will see if it's worth it, if your stock is undervalued or overvalued. If it's undervalued, they'll buy it because they know that it's they're really buying a lot of value for less money. If it's overvalued, they're saying, oh, hang on, not going to do that, because where's it going to go? It's going to go down. So price earnings ratio, if the price earnings falls, then stock may be undervalued, you'd buy that. If the price rises, then it's overvalued, you'd sell that. And so here you go, because it's going to go down, so you're going to sell it. So the price earnings ratio is the stock price over the earnings per share. And again, you take out the preferred dividends, and here you just average out the equity here to get a sense of what your return on equity is. And then also you could calculate a payout ratio, and that's the percent of profits that are not reinvested. And higher payout ratios encourage more investors. So they know that there's people who are just dividend-driven share buyers, because they put their trust in the dividends that they're going to get, and that's how they drive their stockholder strategy. Okay, so you're going to do a balance sheet for the Cupcakes assignment, and here's the way to look at the balance sheet. So you're looking at how are your assets being used on this side of the balance sheet, in terms of the cash, accounts receivable, prepaid expenses, all those things. And then you look at how we get and use the money to run the business. So that's how this all breaks down. The more retained earnings that a company takes on, the more capability it has to invest for expansion, or save for a rainy day, or all those other things. So that's where that goes. Okay. Other things, the burn rate is that, okay, you have that cash, how fast are you using that cash? And so what does that tell you? Is that you got to understand how fast are you bringing in cash versus how fast the cash is leaving the organization in terms of burn rate, to be able to stay in business. Okay, so by doing that, if you've got a negative arrangement here, you're going to see what the time to insolvency is. That if if your cash is coming in slower than what's going out in terms of burn rate, well then, you could figure that out in terms of how many months will I be able to stay in business unless I do something about it. Okay, talked about inventory turnover a lot, or inventory itself. So the whole idea is that the faster you can turn over your inventory, all right, the less working capital you have in the business, and the more profitable you are. So that's getting back to inventory turns is a signal for profitability, and then also what it does is that it'll also tell you how many days of supply that you have. So how long will it take to sell goods? So if you divide 365 by inventory turns, you'll be able to see how that works. So you can see in the retail business, the days of supply is they have to restock every month. I'll just talk about this one here. Consumer discretionary goods like high-end retail. I'll give you my gas example. So I put in a new gas range 2 months ago, and I ordered it off of Best Buy. That's what you do. And then the package comes, and lo and behold, the end caps for that range weren't there. Okay, so I call the company. They say, well, it'll be weeks before we can get that. But if you go to a supplier, you can buy spare parts. All right. Well, how many people buy gas caps for their thing? Very little. All right. So what that meant was those 5 caps that I bought, probably production cost of about maybe $3. They wanted $350 for them. Why? Because not very many people buy them, and they stay stuck in the inventory for months to years. All right. So that's how you start looking at what your inventory turns look like. Okay. So you need to do a cash flow analysis, in terms of days to pay, and look at that. And then you're going to be asked to do 15 financial ratio calculations. This is 15 right here. And then you're going to be shown how to compare them against an industry, and that's what we call benchmarking. And the thing is that go to Professor Power's video on financial ratios, and you'll get a full explanation of how to do that. All right. So here's what she's chosen here. Well, in your cupcakes example, you're going to have to compare it against the restaurant statistics that are prepared by Statistics Canada. It's number 722, and it's small and medium enterprises. And so that you're going to compare some of your KPIs to their numbers. In this case here, in the video that that this is coming from, and the slide deck, is that Professor Powers is talking about comparing something to a hotel. So if that your net sales to fixed asset as a hotelier is maybe 1.0, you're doing much better than the industry. That's the kind of thing to understand. So it gives you a sense of, you compare, and then you'll know which areas that you need to improve in, and which areas that you excel in, so that you'll know that you can manage that differently, right? You always look at managing your strengths and managing your weaknesses, to be able to compare, see what the gap is, and then take a corrective measure or a recalibration. And again, you deal with the root causes and not just the symptoms of why that's happening. Okay, so that's what that is. So here's the piece that she goes through, where you're going through these 15 ratios, and those are the formulas for that. She'll be doing some numbers inside of the video so that you can understand how you calculate them. But then, you got to interpret. So are your profits satisfactory? How do you know? Well, you got to compare. And not only can you benchmark against your industry, you should be benchmarking against key competitors. And you can do that. Are your assets productive? Are they, how efficient is your production? How do you know? Well, you compare against best in class in your type of production. Best in class is just what it is. They're the most superior in terms of producing something efficiently and effectively. Can the business pay its debts? Well, how do you know? Well, you take a look at, what's the industry figures on paying back the debt, and then, how are you doing? And then maybe you have to reconsolidate your loans, or you have to, reduce your costs so that you can make more profit to pay down your debt, all those kind of good things. And then how are the business assets? Are they producing? Are they in the same condition, in your business life cycle as they are of your competitors or the industry? Is the equity in the business satisfactory? Does it allow you to expand? Those kind of things. So here's just an example of benchmarking where people were looking at comparing just 4 hospitals and looking at the types of expenses to see where other people were doing better and other hospitals were doing not so good. So here's an example. If you want to take a look at warehousing logistics, where do you go? Well, you'll benchmark Walmart. They have some of the best, warehousing logistics in the world. Some of the instrumentation that you use is military grade or better. All right, so they really know how to do this business. They know that, they have point of sale data. So as soon as something's coming off the shelf, the computer will tell which supplier to send what products, those kind of things. So those are the kind of things that will really help you. So benchmarking, here's what it is. It connects best practices to strategies and goals. And one thing I'll tell you about benchmarking, I've done a fair amount of it in my, in my other lives, is that some things that you benchmark, you'll go and you'll see something that's fantastic, but it may not apply to your organization. And you have to test if it's going to apply, because some best practices are done and you can't emulate them because of the type of organization you have. So you have to be really careful. You don't just say, oh, that works really well, let's do it. You got to test it, make sure that it's going to work really well for you. Okay. All right. So again, now this is the deliverables for participation 6B. So you're going to have to create a balanced scorecard. And I'll tell you right now, the balanced scorecard has these 4 components, but you're just looking at the financial components. So you're going to fill out the financial components for the cupcake exercise, and you're going to leave the other 3 empty because we're not looking at those areas for this assignment. Okay, what should the KPI for the organization be? Well, you're going to be asked to come up with 3 main KPIs. And what the thing is that if you have too many measures, you won't get anything done. So what you do is, you try to have the right measures for the right amount of goals, and then that's what's really going to drive success in your organization, because it's got a lot of clarity, and you can align your people and your processes and your systems around, those KPIs. Okay, so what is a reasonable production goal? So talk about, well, maybe we want to increase our production by 10% over next year. Yeah, I mean, if we're producing 10 gingerbread houses this week, next week we want to produce 12. That means that you want to increase your production by 20% in a week, that kind of thing. And then how do you improve profitability? I'm giving you all kinds of examples in these slides, so go back into the slides and look at what's going on. So here's a template that I use, and I've used with many companies because I do some consulting. And what you're looking at is that you start with a vision statement, and this is for a values-driven organization. You understand what the core values of the organization are, and then from that you can really design a great mission statement. And then once you have that, the mission statement is what business are you in? Then you a quandary around what are the critical success factors of this business. What's key? What do I need to do to be successful? And then that really gives you an idea of what focus areas that you need to work in. I'm telling you too much right now for the assignment, but I'm getting you ready for the planning part as we go down the road in this course. And the focus areas really break down. They chunk the vision in terms of areas that is doable. And so now you can see, well, you have a focus area in a particular area. You'll set up a goal for that. and then you'll have maybe 1 to 2 or 3 objectives that you need to carry out to satisfy that goal, to achieve that goal. And lo and behold, you'll have to set up some key performance indicators to monitor inside these objectives to make sure that you're performing according to what target that you've established in your goal. Okay, that's how that goes together. So here we go right back to the balanced scorecard and learn again that we're, for the assignments we're talking about, we're going to stick into the financial areas, but they're 4. And you can see in this template now, you can see that, you're going to set goals and you're going to have objectives. You're going to have measures, which are KPIs. You're going to have key targets for those measures. And then in some cases, the objectives are quite large. So you might break down those objectives into projects or initiatives that will get you to satisfying the objective and satisfying the overall goal. So that's how that works. So here's an example now of a strategy map for your exercise. And what you're going to do is you may change these a little bit, but you'll come up with an objective for the finance portions and come up with key performance indicators to satisfy those objectives and the goals of where these objectives are going, and then come up with a score. And what you're going to do is just do it for the finances, and you're going to leave these 3 empty, for just future reference. Okay. So here's some key performance indicators, some examples: revenue per client, current ratio, customer satisfaction score. So that's going to, and now we get down to, and again, in the video, she explains this. So you'll be able to see this. So you're going to be in the finance areas for your Cupcake project. And you're going to say, okay, for a productivity goal, I'm going to, my objective is become an industry cost leader. And what am I going to do then? My target is I want to reduce my cost per unit by 20%. Okay, by 20%, say in a year, right? And lo and behold, you only got to achieve a 10% reduction. So 10 over 20 is a 50% score. And then on finances, 40 over 50 is an 80% score. You average these 2 out and you get to 65% as a mean performance. So that's what you're going to be dealing with in your Cupcake piece, okay? And again, we're going to talk about a strategy map, and there's all kinds of common mistakes, but I'm just going to focus on 1 right now, or maybe, no, 2. So goals without connections. In so many organizations, because I've been in corporate planning and strategic planning for many years, and what I found out is that different departments in the same company will come up with competing goals or conflicting goals, and so it's not all connected. So you have to take a look at the overall organization and see how they all connect to get to the the end piece of satisfying the vision. And so I'm going to show you that in a strategy map. And then also having too many goals is a big mistake, because then you don't get anything done. And I'll show you some research that I've done myself. And then also understanding, here's one thing here, using lagging metrics only. So what's a lagging indicator? Well, how many sales you did last month and how many sales you did the previous month to last month. That's a lagging indicator. You're in the existing month. You don't know, how many sales that you're making. Okay. But having said that, you know what your hit rate is. So if you look at the sales funnel and you take a look at, all right, so how do I make sales? Well, I need a whole pile of leads. And then when I get those leads, then I need to qualify those leads, right? When I qualify those leads, then I need salespeople to visit them. And then when they visit those qualified leads, they make a few sales. So let's say I have 1,000 leads, and then I go through that process, I make 10 sales. So I know what that hit rate is, okay? So what am I going to do then? Every month, I'm going to measure how many leads that I'm taking in, because then I'll get a sense of how many leads that I need to, get in there to be able to make 10 sales a month, right? Okay, so I'm hoping that, let me see here. Okay, I'm hoping that that person just muted themselves. Okay, so that's what a leading indicator is. It's something to use as a predictive measure of future performance. And that, that's not adopted as much in overall business as lagging indicators. And that's where you can, you could really prove yourself in your next career. Okay, so here's a method of planning that I'm going to be talking to you in the future, but I wanted to give you a sense of where the goals come out of. So you have, where are you now in planning? Where are you now, the current state, and where do you want to be? So, to supply that vision, what goals do you need to be able to achieve? But here's the thing, all right? This is the research that came out of the Franklin Institute. If you have, what the research said, if an organization has 11 to 20 goals, the chances of completing those goals are zero, okay? Goals achieved with excellence. If you have 4 to 10 goals, well, maybe you can do 1 or 2 that are really pretty good. But if you only have a few critical goals, then you can achieve them all with excellence. So that's the key piece to remember in this piece. And then understand how this strategy map comes together. So here's some work I did with a particular example. A particular client, and you can see that this is organizational capacity, this is internal business, this is customer, and this is the financial end of this balanced scorecard. And you can see that here's where you start. You start on the learning and growth, or what I call organizational capacity goals, and you make sure that they connect and they support it, and you can see where the connections are, right? So in order to increase your funding, you really need to go through all these steps before you can actually, have the capability to be able to increase your funding. That's the whole idea. So that's what this is all about. So when you look at your learning and growth, or your organizational capacity and capability, when you get that done, then you can drive your internal, improve your internal processes. And then once you can do that, then you can improve your customer and stakeholder satisfaction, and then you can improve your financial results. So that's the whole pattern in this balanced scorecard and its strategy map, which is very, very powerful. And again, Professor Powers gave you a key thing. Basically, these steps just talked about, myself taking you down all the way from, oops, let me see, sorry. I can't find it. Yeah, it's taking you, that list is taking you all the way down here that I showed you, all right? Okay. We're getting fairly close to the end here. I'm sorry that I'm rushing, but I'm trying to get through this whole piece. You got to understand, when you're looking at, where are you now? Where do you want to be? What goal you set? And then because of what your goal you set, what target are you setting for that goal? And then based on that target that you're setting, what measure are you using? Okay, so what you do then is that you measure that actual performance in terms of what's being measured and how is it being measured. And then you compare that performance to a standard or a target, and then to a standard. But let's talk about a target. So you can see that, if you're not quite at the target, what a variation is. It's the difference between what you said you were going to do and what you actually achieved. And the accountants call that variance. So you have to explain the variance. And then, you compare that performance to a standard. So you'll see that, okay, I'm in the donut business, and I know that Tim Hortons has an industry benchmark on on how many donuts one person should create in a day. So I'll look at my performance for one person and then compare that against the industry benchmark, and then say, oh, geez, I'm way back. So what do I need then? Well, maybe I need to train that person better, or maybe I need better machinery. Or then if I'm above, I'll say, oh, geez, maybe I'm putting too many resources into that piece. Sometimes going over a benchmark best practice is you're putting more expenses in, and maybe the customer isn't even recognizing the increase in performance. And then you compare that to, well, how did I do that last month? And how did I do that last year? Am I improving, or are things getting worse? So that's what this control cycle is all about. And the thing is, there's two ways to correct. One is the basic corrective action. Now I'm going to talk to you from a total quality management perspective. That's really when you look at the root causes. Because if you don't get to the root causes and you just deal with the symptoms on B, chances are you didn't really fix the problem, and it hasn't gone away, so it's just going to come back. Maybe you're just dealing with the symptoms. But having said that, sometimes you're in a real bind. Maybe you're producing on a production operation, and things aren't working quite right, and you don't have the time to be able to investigate the root cause, but you can bolster the performance because the customer at the other end is waiting for a delivery, and if you don't make that delivery, you might lose that customer. So that's when you do an immediate corrective action. It corrects problems once you get the performance back on track, but you need to go back and recycle and go to the root cause to make sure that you got that out of the system. And then there's another piece where you take a look at, okay, what's the managerial decision process? This is pretty simple, all right? So you take a look at, okay, what's the standard? You measure, is there a gap? Well, if there's a gap, well, is that gap acceptable? If there isn't a gap, is the standard being attained? Well, you don't do anything. But if there is a gap, you say, well, how does that compare variance-wise? Is that just a normal variance, or is that like a special cause? I'm getting into statistical process control here, but if it's a special cause, you think, oh, I got to do something about this because this problem is not going to go away, all right? There's something definitely wrong. So I'll fix something, and I'll say, oh, but where's the standard? Should I change the standard? Should I maybe just lower the standard and then lower customer expectations? Or should I improve the standard because I'm just not being competitive enough? And then so I revise the standard if I need to. So that's what this is all about. But here's a really kind of revealing a slide. All right. So when does control take place? Well, you notice these little dollar figures here? Well, if you can, fix this problem at the earliest stages, it's not going to cost you as much money. And that's why when we talk about leading indicators is going to give you a good look at, hey, something's not right here. Let's get into looking into this problem. How come I got half as many leads as I got last month? And if I fix that right away at the root cause, man, then I'm okay. Or all of a sudden you're going through the process and something isn't quite right, and you fix it on the fly. That's concurrent control. You correct the problems as they happen. And instead of trying to predict what could go wrong, or doing predictive maintenance and doing actual preventive maintenance on this end, here you let the machine break down and then you fix it as you can. Well, that's still going to cost you a lot more money than if you would have scheduled a shutdown and looked at other alternatives and not upset your overall production area. And then on the outside, on the output itself, there's nothing worse than, okay, you make dishwashers and you ship them 1,000 miles away, and lo and behold, they're all defective. Well, what happens? You have to ship them all the way back. You have to find, get somebody to fix them. You have to take them apart to fix them. So that's many, many more dollars. So that's, this is the kind of a signal to tell you, in your own business, where you start looking for problems and how can you improve your costs overall and improve your profitabilities. The last section is on economic value add. And that's where, your financial analysis comes in big time, and you measure, your corporate overall company and divisional, your divisions or your departments performance And then understand, what they're doing is, you're looking at this formula for economic value add. So you look at how much profit you're bringing in, operating profit. You subtract the tax. You subtract the annual cost of capital, like your interest, and you see, is that economic value added, is it growing or is it decreasing? And if it's growing, then you got a lot going for you. And then you say, well, why is it growing, and why can I do this in other places to improve my overall lot? If it's decreasing, you start looking for problems and saying, what's going wrong here, and how do I deal with that? And then there's market value added, and that's where the stock market will tell you if you're doing okay. So it estimates the ability to increase shareholder value. And how do you do that? So you look at the common stock plus the liabilities minus the cash and the initial capital investment. And if your market value add is growing, it means your shareholders are going to be happy, and then you're going to entice more people to come in and buy your stock. That's how that works. So we went through this piece of profit planning process. I just wanted to show you one of the pieces is, in your slide deck, you'll see that there's a sales and revenue line here in terms of, you increase your volume of sales over time, and then you take a look at your cost line, and you have fixed costs. So right at the beginning of the month, you still have to pay your managers, you still have to pay your mortgage, so you could see these costs as fixed costs right at the beginning of your month or the beginning of your company. And then as you start producing more, you start increasing your variable costs. So you're building more gingerbread houses. Well, you need to buy more biscuits, and you need to buy more icing sugar. And you go through and you look for this crossover, and this is the break-even point. Okay, so what you're saying then is that this is where you're making profit. Anytime your sales revenue is above your cost line. So it takes you a long time before you can start making profit. So they say, well, you can increase your profitability by lowering your break even. So what that means is you want to accelerate your sales revenue. So what I've taken this revenue line, and I've increased the slope of this line, so that you're getting, more sales in a shorter time. And lo and behold, look at what's happened. Your break even point has dropped down lower. Okay, so I just wanted to show you that, and that's where that piece is. And we're getting really close to the end here. I just wanted to tell you that go through the risk management piece and understand, well-run companies will have a comprehensive risk management framework in today's world. Like I said before, it was just accountants that looked after that. Now everybody's involved in the risk management pieces, and in every area. And this is not in the course, but I wanted to show you, people will build risk heat maps. And what they show is that, on the x-axis, is the risk, the impact, is it very high, low to high? And then the probability of happening, is it rare or high? So you look at, your most important business risk issues are up in this quadrant here. All right, and then as your least important ones show up here. So it gives you a good view right away. You can tell where your issues are, and it really sends immediate signals in the organization. And then you know that there's speculative risk, and that's you're betting the company or you're betting the farm on something, and you don't really know how it's going to end. And there's some operators out there that will do that. And then just understanding pure risk. And pure risk breaks down to property risk, liability risk, personnel risk. So property risk, am I in a tornado alley? Liability risk, well, I'm producing these products that could produce harm to people. Am I covered around that? And then personnel risk, are my workers safe? Or did I put them in precarious health threatening places or accident threatening areas? So those are the things that you look at. So here's the process. You identify and understand those risks. You evaluate the potential severity. You select methods to manage it, and then you implement the decision and you review and evaluate. But here's the types. I mean, the strategies for that. You avoid it. Well, you say, you know what, this part of the business is so risky, we're not going to produce these kind of products anymore. We're just going to avoid that. Mitigation is, we know there's certain kind of risks at certain times. So what we're going to do is, we're going to do a lot of training. We're going to do a lot of, to make sure that people understand, how they should be safer or whatever. And then we're going to put in safeguards so that we reduce possibilities of loss, those kind of things. And then the other one is transfer. All right. So what it is there might be a real risky part of your business. What you'll do, you'll outsource it. You'll go out and say, hey, you know what? I want company A to do this for me. It's just too risky, and they can assume the risk. And then the other one is, okay, we know this is going to happen at some point in time. Let's just insure it, and we'll do that. Let me see here. I think that that takes me. I'll just go right through this piece here. So the whole idea with risk is that we talk about environmental scanning. Well, in today's world, you've got to do internal environmental scanning. What's happening in the organization, and how are those risks coming about? And then what's happening outside the organization? What's going to stop us from doing our business? What kind of threats are out there? And then it initiates discussions, and so that we understand what these risks are and we can quantify them. And then we also gather input from our stakeholders so that we can manage them, right? And then here's the type of insurance that you can come in, and that's basically where we are for this this presentation. So again, these three are the deliverables that for 6A. These three are deliverables for 6B. And if you take a look at doing this, you prepare yourself, then you'll see that you're going to be well prepared for what they're asking for in the Cupcake exercise as a group thing, and understand that you're going to only be asked for 3 KPIs and the reasons for choosing these KPIs. So when I talk about critical success factors, that's where I'm saying, hey, yeah, let me know why that's so critical. Why you're choosing these 3 KPIs. What targets are you associating with those key performance indicators? And then if you have any questions, please email me. I'll put the answers out on Blackboard announcements so that all your colleagues can benefit from it, and we'll go from there. Okay. So any questions? And I can't see the board here because I got something that I can't get rid of. But anybody can unmute and ask a question if you have any.
Hi. Can you hear me?
Go ahead. Yeah.
So we have a deadline for tonight, and that's the individual portion of the project. Is that?
I'm sorry, I can hardly hear you, so you're gonna have to speak a little louder and just a little less fast.
Okay. So we have a deadline for tonight. It says the individual portion of the team project. Is that due for tonight, or is it for December?
No, the individual, and I think I may have answered this already, but the individual portion of the team project is due December the 1st. And if you see some things that aren't quite right, in Blackboard, please consult with the course outline first. And if it doesn't reconcile, I'd appreciate an email right away, and I will get an announcement out, right? But it's just that I've been, going through, I started off, I had 2 weeks to prepare to get into this course. So I did the best I could to kind of check things. And now I'm continuously kind of revising the course outline to reflect, what the true deadlines are. So yes, so it's December 1st, so you got a lot of time to be able to address that. Okay.
Yep, thank you. Oh, and one more thing. It says there that reflect on based on like a theory. Is it what kind of theory is it?
Sorry, what was based on a theory?
Like there's like this question that says like given on this reflection, like based on our reflection on our how do I say this? Like on our reflection related to a theory. There you go. Like what kind of theory is it? Like theory from all the theories that we have tackled, or just like a specific theory?
Is that something that I said or wrote? Is that?
Yes, it's on the question. Hold on. Let me just pull it up.
Yeah.
All right. So, like, the number one question is, what are the characteristics of effective communication relevant to your team project submission relate to theory?
I'm sorry, I have a hard time listening to you. Is there any way you can share that?
How do I share this? Would it help if I just like email you?
Email me, and then what I'll do is I will address that question and I'll put it on announcements, all right?
Okay, sounds good. Thank you.
Yeah, sorry about that. I
Don't
just
worry.
can't remember where I said that, so,
Yep.
okay. And any other questions? Okay, like I know that this week was, there's a lot of information there, and that's why I tried to shift, these projects to, project groups, sorry, these assignments to project groups to make it easier for you to get through the workload, okay? All right, okay, so in any case, if you have any questions, email me. That's the best way of me understanding what you need to know. And then if you do have any general questions, say, well, I need more clarity on something, give me some questions based on, where you're getting at so I can better answer your question and more specifically, okay? And one other thing, I have two streams. I have an A stream, which is daytime, and I have a Z stream, which is remote. When you email me, just let me know which stream you're out of, like that you're from the remote stream, and that way I can get back to you a lot quicker. Okay. All right. Okay. Good. And we'll catch you next week. Take care. Hi, Amelia, are you on?
Yes, hi.
Yeah, sorry about that. I forgot about
Yeah. I
yeah,
can see that there's still someone here.
yeah. Uh, okay.
Thank you so much for giving me a time.
Okay, no problem. I'm just wondering here what we can do with Crizel here. How about,
Can we,
uh, let me see here. I'm going to, what I'll
group
do
just
is,
on the
what I'll do is I'll end this meeting and then I'll just get you to join me on a separate meeting. How's that?
okay.
Okay, so just
Yeah.
let me, so what's your email, just in case I can't just find your name.
Mildred.
Can you just put it in the chat, and then I'll then I can just copy it. How's that? Okay.
I can just call you the reference.
Sorry?
I can just
Okay,
call
so
you the reference.
yeah, I'll just get out of here, and then I will
Okay.
I'll start a new meeting. Okay.
All right.
Oh, come on, come on, come on, come on, come on.
Hello.
Oh, hi. Okay. Okay, so how did you score on that test?
I think it's 38.
Okay. Okay, and just tell me a little bit about yourself, Millie. This is your second year, right?
Basically, it's my first year. I'm in business certificate,
Okay.
and this is my last term.
Okay. And what, okay, what's your goal in this course then? You want, do you want to achieve like 60% plus, or what, do you need to get 60% on this?
Yeah, at least pass the course.
Okay. And so what did you have in mind?
Looking for something like a special project or a different exam to catch up.
Okay. See, this is the conundrum here, is that, I don't want to set a precedent, so that if we do this, like just you and I, all right?
Yes,
And
of course.
I want to do it basically on the merits. So, give me justification why I should do this for you to run another test.
Yeah, well, basically, just to be honest, it's my first time taking the exam through that setup. I've been taking the exam. It's like that I'm overwhelmed if there's like someone's looking at me
Yeah.
and Yeah. It's like if I know that I'm being recorded, I'm like really confused. It's just that I'm not used to that setup. Maybe that's one of the main reason.
Yeah.
Yes.
Okay, so based on that, I'm going to say, those are the merits to allow you to take this. So I'm going to let you do the test again, okay?
Okay.
And what I'll do is I will set it up for you. So do you want to do it on the weekend or when do you want to do it?
Yes, weekend is better, like Saturday or Sunday.
Okay, so give me a day and a time.
Okay, let me check. Yeah, for I think yeah, Sunday is better. 1 p.m. onwards.
1 p.m. Okay, so what'll happen is that test will appear right at 1 p.m. Okay,
Okay.
and then we'll do it all the same way with the same stuff, with the whatever it's called, the browser and everything else. And just know that, hey, I'm not going to be watching you while you're doing it. I do have the recording of you, but did you finally get it all set up though, and you didn't have any problem with the browser?
Yeah, I have no problem with the browser. I used it before, like
Okay,
multiple times. It's just the first time for having the webcam. That's that's the only thing. And I cannot see myself as well. Like once the exam is started, I cannot
yeah,
see myself even just on the end.
okay,
So yeah.
all
And
right, but
also
understand that.
yeah,
Okay,
I
I'm
find
basing
this
this on special merits here, right? Because I don't want students coming to me saying, well, I didn't do so well. Can I do this test over
yeah.
again? And then I'm into a conundrum here. All right.
Thank you so much. Yeah, this is just between us. And also, I find this course like overwhelming. Um, Listening to like what I've said for the participation 5, I really struggled to that one. I don't know where to start, what to do. But I find your commentary, and this is really helpful for me. So yeah, I know where to start now for this upcoming participation 6.
Okay,
I can see that all the informations
yeah,
from there
and
already.
I understand, I'm new, so I'm finally getting a rhythm, to understand how I can help students in this course. Because there was so much work done by Professor Powers. And the thing is, I'll acknowledge, I mean, this topic 6, I mean, this is a course in itself, not alone getting through it. But it is so important. And, like I said, I've done a lot of business plans for many small and medium-sized businesses, and most
Mm.
key managers and owners don't understand the financials, and you've got to run by the numbers as well as being smart enough and talented enough to be successful in your business. So this is key, this chapter, that's for sure.
Yeah. Okay. Yeah. I
Okay,
understand.
so
Yeah.
I will set you up, and then we'll just go from there. Okay.
Okay then. All right. Thank you so much.
Okay, you're welcome.
Have a good day. Bye.